By now, you have probably heard the name Silicon Valley Bank, or SVB. How did a financial institution at the heart of innovation end up going bankrupt and sending shockwaves through the banking industry and beyond? Unlike the credit crisis of 2008, which was driven by a collapse in the housing market and the resulting subprime mortgage crisis, the collapse of SVB was driven by a mismatch in liquidity between customer deposits and long maturity bond investments. In simple terms, the bank took in customer deposits that need to be liquid for withdrawals and invested too much in bonds that mature many years down the road. These types of bonds fluctuate dramatically when interest rates move quickly. This strategy had worked well for SVB for years, allowing it to earn high returns on investments while providing funding to fast-growing startup companies. Recently, some of the bank's customers began to withdraw their deposits to fund their businesses due to the slowing economy. At the same time, SVB's long-term bond portfolio dropped significantly in value due to the Fed's drastic move to increase interest rates at an unprecedented speed. As interest rates increased, the market for SVB's bond holdings became less attractive. Current bond market investors demanded higher interest rates than the long-term low-yielding bonds that SVB had unwisely locked themselves into. This created a vicious cycle, with the bank struggling to meet its immediate funding needs, and it had to sell its own bond investments at a significant loss. As word got out that SVB was facing these headwinds, more bank customers began to withdraw their deposits out of fear, causing a run on the bank. Despite efforts to shore up its balance sheet, SVB was forced to seek emergency funding from the Federal Reserve. However, the damage had already been done to the bank's financials. One of the key lessons financial institutions as well as individual investors can take away from the collapse of SVB is the importance of matching one's liquidity needs with investment time horizons. This is something that we encourage our clients to address each time we meet with them. In fact, it is such a basic tenet of finance, we're shocked that SVB got themselves into this situation. We routinely ask our clients, what are your short-term liquidity needs? And do you have any large liquidity need coming up in the near future? This is a critical piece of your overall financial plan and is unique to every personal situation. This current situation with SVB also highlights the importance of transparency and communication. SVB's collapse was exacerbated by a lack of transparency, leaving customers, investors, and regulators in the dark about the true state of the bank's finances. A comparison can be drawn to the importance of consistent portfolio reviews, which we request of all clients at least once a year to keep an open dialogue and understand your unique and evolving needs. Do you have questions about the current banking situation or your finances? We're always here to help.